All right, let's dive right in. There's a huge new housing plan making waves, announced by former President Trump, and it's all about making homes more affordable. So we're going to break down exactly what this is, how it's supposed to work, and what it could mean for you and the housing market.
So it all kicked off with this post on Truth Social, all caps, very direct. The message is pretty clear. Pump $200 billion into buying up mortgage bonds. The goal? Force mortgage rates down, which in turn lowers your monthly payment. It's a pretty bold and straightforward shot at tackling the affordability crisis.
And interestingly enough, right after this was announced, the average 30-year mortgage rate actually did dip. In fact, it hit its lowest point since way back in early 2023. Now look, a lot of things move these rates, but you can't ignore that timing, right? It definitely got people's attention.
So let's just state it plainly. What's the ultimate mission here? It's really simple. The whole point is to wrestle those mortgage rates down, because they've been the single biggest barrier keeping a ton of people from buying a home.
Now, if a plan like this gets put into motion, you've got three main characters on the stage. First, you have the president, who gives the order. Then you've got the two mortgage giants, Fannie Mae and Freddie Mac. They're the ones who would actually have to go out and buy the bonds. And overseeing the whole thing, that'd be their regulator, the FHFA.
So why do we care so much about this? Why does it matter? Because mortgage rates are a massive deal. They don't just affect your wallet and whether you can get a loan. They create these huge ripple effects that touch everything: home prices, how much money people are spending, and really the health of the entire U.S. economy.
Okay, to really get what's going on, we got to pop the hood and look at the financial engine this plan is trying to rev up. We're talking about the world of mortgage bonds.
The key piece of the puzzle here is something called a mortgage-backed security, or MBS. Just think of it like this. A bank takes thousands of individual home loans, bundles them all up into one giant package, and then sells that package to investors. This frees up the bank's money so they can go out and give more loans to more home buyers. It keeps the whole system flowing.
So here's the normal cycle, step by step. You go get a mortgage, your lender then sells that loan to Fannie Mae or Freddie Mac. They take your loan, bundle it with thousands of others into an MBS, and sell that to investors. Simple enough? Now here's the twist. The new plan completely changes that last step. Instead of selling those bonds to investors, Fannie and Freddie would be ordered to buy the bonds themselves. The economic theory is that this huge new demand will jack up the price of these bonds, and when their price goes up, interest rates have to come down.
And that leads us to the real, I guess you could say, $200 billion question. Is that amount of money actually enough to make a real difference? We've got to put this number in context.
Because that's the real challenge here. You're talking about injecting $200 billion into a market that is valued at an absolutely mind-boggling $11 trillion.
This chart says it all. That little slice representing the $200 billion plan, it's just a sliver of the whole pie. We're talking less than 2% of the entire market. It just goes to show you the massive scale we're dealing with.
But here's the wrinkle. This isn't actually coming out of nowhere. Fannie and Freddie have already been buying more of these bonds. In fact, their holdings have jumped by over 25% since last June. So this new directive wouldn't be starting a new trend, but more like hitting the accelerator on something that's already happening.
Okay, but as you can probably guess, not everyone is sold on this idea. There are a lot of skeptics out there. So let's flip the coin and look at their side of the argument.
The number one reason for skepticism really comes down to size. Just look at this comparison. The proposed $200 billion plan is completely dwarfed by the bond buying program the Federal Reserve did recently. That one was $2 trillion. So critics are asking, if the Fed's much bigger effort had a pretty limited impact, how can a plan that's 10 times smaller make a lasting dent?
And you hear that exact sentiment from industry experts. Someone like Joel Berner, a senior economist over at Realtor.com, came right out and said it. He predicts any impact will probably be, in his words, modest and short-lived.
And Berner also brings up this huge potential backfire. Okay, so the plan works, rates go down, great. But what happens next? A flood of new buyers could rush into a housing market that already has way too few homes for sale. And when you have more buyers fighting over fewer homes, well, you get bidding wars. Prices go up. And you could easily see a situation where higher home prices completely cancel out any savings from that lower mortgage rate.
So for the last piece of this puzzle, we have to zoom out. You can't just look at this plan in a bubble. You have to see how it fits, or doesn't fit, with some of the other housing policies being talked about. And that's where things get complicated.
Yeah, because when you look at the bigger picture, you spot a pretty significant wrinkle in the whole strategy.
It's like you have two completely competing ideas on the table at the same time. On one hand, you have this plan that uses government control over Fannie and Freddie to force rates down, but on the other hand, there's been serious talk about privatizing those exact same companies. And pretty much every analyst agrees that if you privatize them, if you take away that government backing, mortgage rates would almost certainly go up, completely undermining the goal of this plan.
And this is all happening at the same time as another big idea floating around, a plan to ban huge investment firms from buying up single-family homes. It really shows there's a multi-front attack on the housing crisis, even if some of the battle plans seem to be pointing in opposite directions.
So that's where we're left. We have this big final question. Is this $200 billion idea a bold move that could finally bring some relief to homebuyers? Or is it just a temporary fix? A Band-Aid whose benefits might get wiped out by other problems, like rising prices or even conflicting government policies. It's a huge debate and one we're all going to be watching very closely.